Okay, let's quickly look at this illustration to explain the double entry principles and recording of such transactions. Enter the following transactions in the necessary account. We have started business with 8 naira cash, that is January 1st, January 2nd, paid insurance by check, January 3rd, receive refund of rent 15 naira, January 4th, bought furniture by check 500, January 5th, cash drawings 225, January 6th, withdraw goods 300 for use, January 7th, sold goods 400 naira on credit to St. Mike, January 8th, purchase cash purchases of 800, January 9th, cash sales of 560, January 10th, received loan 1000 from Mercy. So that is the question. We want to take it bit by bit, and we will show the effect of such transaction. We will show the action to be taken in recording it. Okay, so let's start one by one. Let's deal with January 1st. January 1st, started business with 18 naira cash involved. Started business with 18 naira cash involved. Here, we remember we talked about earlier on, the entity concept. Here, the owner of the business is introducing fund into the business, and that amount he is introducing into the business is known as what? Is known as a capital. So the two accounts involved in this question is capital and cash. Capital is giving and cash is receiving this what? Receiving this money. Capital is giving, cash is receiving what? Is receiving this money. So what do we do? The actions to be taken. So action required to record this is that the giver here is capital. Capital is giving out cash. So capital is the giver. So required action is what? We should credit the giver. So credit capital, which is the giver, and debit cash, which is the receiver or the receiving account. And what would be the effect of this? What is the effect of this? Remember, cash is an asset, and from our previous illustration, a debit entry in an asset means what? There is an increase in what? In an asset. So there is increase in assets. That asset here is what? Is cash account. And a credit entry in liability. Capital is a liability. So there is increase in what? Increase in what? In liability. And that liability here is what? Is capital account. So that is the actions to be taken and the effect of this transaction. So let's see the next. January 2nd, paid insurance by check. Paid insurance by check. Money, the two accounts involved here is insurance, and whenever payment is made by check, we represent it in accounting as what? As bank. So there's nothing like check account. So have insurance and what? And bank. So who is giving out? Insurance is receiving and the bank is giving out money. So what is the action required to record this? Action required. The action required to record this is that what? we shall credit bank. Credit what? Bank. Because the bank is what? The bank is the giver. And debit insurance. Because insurance here is what? Is the receiving account or the receiver. Then what is the effect of this on the financial statements? What is the effect? The effect of this is that as we are creating bank, remember bank is an asset. Bank is an asset. So which means there is what? There is a decrease in assets. There's a decrease in assets, and that asset here is what? Is bank account. Then there is a what? There is an increase in what? In expenses, and that expenses here is what? Is insurance account. So that is the effect. Okay. Receive refund of rent. Receive refund of rent. 50 naira cash. Receive refund of rent. 50 naira cash. Rent was paid. It means that there is an excess payment for rent, and rent account is what? Is refunding the money. So the two accounts involved, that like the two accounts here are: one, we have the rent account, and secondly, we also have the what? The cash account. So these are the two accounts involved. What is the action required? Action required. The receiving account here is cash. So the action required is rent is giving a refund to cash account. So the action required here is what? Is we shall what? We shall credit rent account, because there is a refund. We shall credit rent account, and rent account is simply what? Is the giver in this case, and we shall debit what? Debit cash account, because cash account is what? Is the receiver in this case. As a result, what will be the effect? The effect of this on the financial statement. The effect of this is that there is a decrease in expenses. And the expenses here is what? Is rent. Then there is increase in assets, and that asset here is what? Is cash account. So that is for that will be the entry for the January 3 received refund of rent. The next is January 4th, bought furniture by check. The two accounts involved here is furniture account, which is an asset, a non-current asset, and bank account, furniture account and bank account. What is the required action? furniture is receiving, so we shall debit what? Debit furniture account. Okay, we shall debit furniture account, because furniture account is debit furniture account. Then credit bank account, because bank account is giving out the money. Then what will be the effect on the financial statement? The effect of this on the financial statement is this: there's a decrease in what? There will be an increase there will be an increase there will be an increase in assets, which is furniture account, and also a decrease in assets, which is what? Bank account. So overall effect means what? In overall, there is no effect. Do you know why? They are in both classes. The transaction involved are in both classes of what? In both classes. So there is no increase. The general, the overall effect is that there is no effect on what? On the financial statement, because the two items that are involved, furniture account and bank account, are in the same class. They are in the same class of what? Class of elements. Okay. So the next we need to look at is cash drawings 225. Cash drawings 225. Okay, what are the two accounts involved? There is cash account and there is drawings. There is cash account and there is drawings. It means the owner has withdrew. Has withdrew part of the capital he introduced. So what will be the effect? But before we look at that, let's look at the required action. Cash account is given in this case because it's giving drawings. So the required action here is that what? We shall debit, let's start with the first item. We shall credit cash account, because cash account is the what? Is the giver in this case, and we shall debit drawings account, because drawings account in this case is the what? Is the receiver, that is the receiving account. So what will be the effect? The effect is what? The effect here is an increase in drawings. There is increase in drawings account, and there is what? There is decrease in cash account. Okay, so that is it. So the next one is on the 6th. Withdrew goods for use. Now the drawings of the proprietor, the owner of the business, can be in form of cash and in form of goods. So the two accounts that are involved here are drawings account, also came in here. Drawings account, and purchases account, or for this case now, we can say stock, because the goods must have been what? Must have been in stock. Okay, stocks, and as I said earlier on, stocks means different thing in different countries. So we can say inventories account. So what would be the required actions to be taken in recording this event? We shall debit drawings, because drawings is the receiving account. So debit drawings account, and we shall credit inventories account. That is where you stock your goods, your goods that are yet to be sold, inventory. So what will be the effect? The effect of this transaction is that what? Here also there is increase in drawings. There is increase in drawings, and there is decrease in inventory. Inventories. Okay. So the next we have is sold goods 400 on credit to St. Mike. So the two accounts involved here is sales and St. Mike. Sales and St. Mike are the two accounts involved. So what would be the required action? The required action. Sales is always a given account, so we shall credit sales account, because sales is the giver and is always a given account. Then debit what? St. Mike, who is now a debtor, who is what? Receiver or receiving account. What will be the effect of this transaction? Effect of this transaction: increase in revenue. Increase in revenue, which is what? Which is sales account. Then increase in receivable, which is what? St. Mike account, as what? As a debtor. So that will be the entry for that transaction. The next transaction that we need to consider is cash purchases. Here, that means there is a purchases account. These are the two accounts involved, and there is what? There is cash account. What will be the required action to be taken if we want to record this? The required action is for us: cash is given and purchases is receiving. In fact, purchases is always a receiving account. So we shall debit purchases account and credit cash, because cash is given, cash account. So the effect is that what? There is increase in what? In purchases, which is an expense account. Is an expense account. Expense account. Then decrease in what? In cash, which is cash account, which is a what? Which is an asset. So as you can see, it's an asset. Let's see the next question. Cash sales. Cash sales. So the two accounts involved here is sales account and cash account. As I said here, required action. Require action. As I said earlier on, cash account is always a given. Sales account is always a given account. So our required action will be credit sales account and debit cash account, which receive the money. So the effect is this: increase in revenue account, that is sales, and also increase in assets account, which is in this case cash. Okay, so receive loan 1,000 naira from Mercy. So we have now look at it. It was not stated either by cash or by check. Whenever such is like this and examiner is silent, we always take what? Cash. Take note of that. So this is cash account and what? And Mercy. Mercy, you can say Mercy or you say loan account, whichever one stands for the second account. So the required action is that there is an increase in cash. So we shall debit cash account because cash account is receiving that amount, cash account, and credit whichever name you decided to use, Mercy account, or you use what? Loan account. What will be the effect? Effect of this is that what? There is an increase in assets, which is cash. Then there's also increase in liabilities account, which is what? Which is a loan or Mercy account. So this is how entries are being taken. So this is just a preparation of how double entry should be is being posted. The double entry principle is being applicable or is being posted.